This episode of Market Call is made possible by Robinhood. Try out Robinhood Legend, the all-new free desktop trading platform designed for sophisticated traders like you. While there is no cost to use the Legend platform, there are other fees associated with your brokerage account. See the Robinhood financial fee schedule for more information. Swizzle is back on this Tuesday, July 8th, 11 a.m. on the East Coast. Always joined by Dan Nathan, who's done yeoman's work in my absence. And I apologize about yesterday. Travel plans got changed, but I am back, and I have it's funny. You talk about this all the time. Sometimes when you take a few days away from the market, you can sort of get a cleanse. Like you look at things a little bit differently. And I have looked at things differently. I've come to the same conclusions, though. So there's a lot to talk about here.
You never got doxxed, Guy. I just want to be really clear.
I was in Montauk. I don't know what that means.
Right, you know what?
I was out east.
By
the way, we went to a place. I know you know this establishment. It's called the Clam Bar. It's east of Amagansett. It's west of Montauk on the left side as you're headed towards. It was out. We went there 4 times, and we met the owners. We just had a great time.
He hangs out outside right there and just chatting everybody up. It's totally old school, and you probably went to lunch across the street, that lobster roll
We
joint.
did not go to the lobster roll this year. Oh, wow, look at that. Okay, so here you go. Not that anybody cares. So from left to right, that's John. He's the owner. His birthday was on the 4th of July. That's Kelly, his wife, next to him in the white tank top.
Wow.
That is Frankie, a friend of Timmy's. That is Lily, my daughter. That is Noah, another friend of Timmy's. And that is Timmy. There you go.
Where's Boom Boom?
Boom Boom's not a big picture guy, as you probably know.
He just ducked out. He had to dip with Linda Snow.
Exactly.
All right, so we got a lot. We got a lot about the Adami Montauk annual, by the way. And you look like you did not use the suntan lotion, but that's fine, Guy. You're half Sicilian. It's kind of in your blood. You guys repel that sort of stuff. It's funny about the market last week. You didn't miss a whole heck of a lot. There was obviously some data. There was obviously some pressure by the president on Fed Chair Powell. There was no real earnings. You had that jobs number. The thing about the jobs number, and you were probably watching Squawk and Friends a little bit, Guy.
Mm-hmm.
On the headline, it looked pretty good. When you started breaking it down, it didn't look so good. And that was kind of some of the takeaways, but yields did rise. The 10-year yield went up 10 basis points in a straight line, and the stock market closed at an all-time high, which, probably was because it was open. So you start this week off, and, one of the things that just kind of stuck out to me is that, the tariff deadline was coming, right? We know that they had supposedly this tailwind from the tax bill being signed, but it just didn't seem like there was a whole heck of a lot of trepidation about that July 9th sort of deadline. And now in the last 24 hours, it seems like they continue to walk back. The only thing I'll say, and I wouldn't care who's in the White House, no matter who it was, the way they are conducting this whole process just doesn't seem like they're optimizing for the results that they want.
Listen, I don't disagree with that. And I was reading something, I don't know what publication it was, but talking about how the administration sort of likes the theater around these tariffs, and every day is sort of a new story, and it sort of builds on itself. And maybe there's some truth to that again. But we mentioned tariffs, and what I've come to the conclusion and the realization is, as important as they all are, the underlying concerns that I've had, and I think you share, have not gone away. And quite frankly, they were there prior to the word tariff being used, pretty much all day long, every day. And they're there still today. And if you throw on top of that some of these valuation concerns, and right before our very eyes, once again, that Buffett indicator is at all-time high, CAPE ratios, price to earnings rate, all those things that I do think matter but are not timing mechanisms are absolutely flashing red. Now, I watched the market last week a little bit, and obviously we made a new all-time high in the month of July. And I think that is important. Give me a second here if we can pull up an S&P chart before we get to some of the analyst calls or the strategist calls. So we made an all-time high in July. We also had a little bit of a gap open, as you recall. So we are potentially setting up, and this is just my opinion, for a little island reversal possibly And if we were to close this month below the June low, and I think the June low, if Stephen can sort of find it, was right around like 59 something. And you say, well, that's light years away. Well, in today's world, that's not light years away. And it sort of lines up with the 200-day moving average. And if that were to happen, and again, there's a lot of real estate left in the month, obviously, not only would you have potentially these little gap island reversals that have been created, but you also potentially can have, for the first time in a long time, an outside month. And what does that mean? It means the high in July was higher than what we saw in June. The low in July potentially could be lower than the low in June, and we close below those June lows. So I just want to put that out here on July 8th. This is something that with each day I'll be watching more and more closely.
Well, it's interesting, guys. So there's two gaps, like you mentioned, that kind of 60-50 sort of gap that we have there, and then you just saw that kind of slow grind higher to almost 6,300 or about 6,300. And when the S&P was around 5,950, 6,000, you and I were looking lower down to that 5,700, 5,750 gap. That's when the China tariffs were kind of at least pushed out, that sort of thing. And so listen, before you know it, we're going to be getting to that 90-day sort of China deadline. And let's just be clear. I mean, the whole idea that you're pushing these dates out, that you might get some frameworks and this and that, whatever, there's just very few deals that have been done. And I think a lot of these folks know how to play this administration a little bit. So it is what it is. Tariffs are not going to be the thing that if you're waiting for the market to sell off to get to reload, whether that number is at 50, 950 or whatever the hell it is, that 200-day moving average is down there at 5850 or something like that. They're going to get bought up unless we just continue to have the uncertainty about these trade deals. We had this strategist on, guy from Bank of America last night, and really focused on retail and the all the tariffs and what it means. And she seemed to be fairly certain that some of these new frameworks are going to provide a level of certainty for retailers who are ordering, goods for the holiday season and this, that, or whatever. I just don't see it that way. And Peter Bookbar was on the Market Call yesterday. Was also in the Risk Reversal podcast feed this morning. Go listen to some of the math that he is doing right in and around these tariffs. And it's just one of those things that somebody is going to have to absorb along the way, whether it's in the supply chain, whether it's the buyer, the importer, or whether it's consumer. And that should weigh on economic growth. And let's just be clear, okay? You took a few days off from the markets last week and into this week, and you come back and you have fresh eyes and this and that, whatever. There's not a whole heck of a lot that, in my opinion, has been resolved. The tax thing in and of itself, is that a tailwind? I'm not sure. It's just extending the existing tax levels, right? And then when you think about some of the cuts, they're going to come in a year and a half too, or something like that. So to me, that's not such a huge sort of tailwind. It is a potential headwind no matter any way you look at it. If the tariffs are above where they were on April 1st, that is not going to be something that should be constructive for growth here, and clearly not global growth. Does that make sense to you?
That makes sense to me. And, I'm glad you mentioned the tax stuff, because our live show on Fast Money, I think it was June 7th. Please don't at me if
June
I'm
5th.
off. Okay, so Gary Cohn was on that day. And if you remember, that was a day that it was what has become very famous, the Elon Musk, President Trump sort of dust up. And I think that sort of took the market a bit off guard. But Gary Cohn came on and talked about sort of hidden within all of that was this tax thing that was probably going to get ratcheted through. So Gary proved to be somewhat prescient on that, and he thought it actually creates a tailwind for the market. And he was right, obviously to the tune of probably some 300, 350 or so S&P points. But now to your point, that's all sort of behind us now. And I think all those things are knowns. And what are we left with? We're left with a job market that I think a lot of people are coming to the realization that is clearly softening. You look at delinquency rates. I was looking at auto delinquency rates. I mean, we're probably 10, 11, 12-year highs in terms of that. I mean, there are a lot of things below the surface that clearly a 6,200 S&P is not taking into consideration. I know we're going to talk about yields in a second, but there's something else that happens. And we'll look at, in terms of what we've seen from Savita and David Costin from Goldman Sachs, what you wind up happening in the month of July. And I'm not saying either one of these are doing this. It's not my point. But as we get later into the year, analysts start to chase where the market is. And here we go with Savita going to 6,300, from 5,600. I think David Costin is up to 6,600 now. And I think he was around 6,400 or so. So as we continue to progress, as the market continues to grind, you're seeing this today. This might be the first. It's certainly not going to be the last.
Well, let's be clear, right? All these folks got really negative right after, April 2nd when these tariff rates, and I don't listen, it's a hard game. And I had a great conversation with Brian Belsky of BMO Capital. That's going to drop in the risk reversal feed tomorrow morning, on Wednesday morning. And we were talking about this game of strategists and kind of how they have to move their targets around and how kind of silly it is. And Carter Braxton Worth, he had a great little soliloquy last week, guy, while you were gone on all this. But I'll go back to fast money here for a second, is that, Steve Eisman of Big Short fame was on Fast Money last night. And I wish you were there, man. I wish you were there, because you would have loved him. He was in like Steve Eisman form, and he was talking about how he doesn't care about the debt. He doesn't care about deficits.
Mm-hmm.
He's been saying that fairly consistently. And he goes, everybody wants to call the end of the world. And then he goes, wait, maybe I should say it. Maybe I shouldn't. Maybe I should. And Mel's like, say it, say it. We're all like, say it. He goes, you know what? My job, he goes, Steve Eisman's already taken, and that's me. He goes, so for all those ones who think that they can call the end of the world, and he's like, it's already been done, and I did it. It was amazing. So you got to find that. You would have been laughing just like that. And I didn't do it justice, by the way. So, and whatever, it is what it is. So going to these guys, now they're chasing higher. We love both of them. I'd love, Savita's been on the podcast. We'd love to get Costin on, but let's look at that. So S&P, we got it. We know where we want to be. Let's look at yields. You've been in the higher yield camp. Yields have kind of been stuck here. You haven't been wrong. You haven't been right. I don't really have like a strong feeling about this. I would think with the dollar weakness that the yields would be kind of following it lower. It hasn't. Let's just pull up the 10-year for a second. I mean, you and I were old enough to remember just a few months ago when the yield was below 4%, and it came back pretty quickly. You see the flattening 200-day moving average. It's a hard one to call here, guy.
Certainly in terms of, because you have people on both sides of this fence, people that are saying that we're in this disinflationary environment. And by definition, as you start to see some of the inflation readings come down, the 10-year yield is going to follow. You have other people like me that think it's really not about the economy right now. It's about bigger things. It's about debt. It's about supply demand in terms of the bond market. And by the way, I think it's around some of the rhetoric around the Fed chair and who's going to be next Fed chair. And this belief, misguided belief, that if the Fed were to cut rates, somehow magically the back end of the curve would be affected as well. Obviously, that did not happen in September. I think we all can acknowledge that. And I don't think it's going to happen now if they were to cut rates magically today, tomorrow, or next week. So there's something at play here. And then a lot of people, I'm sure Carter would say, what are you talking about? If you look at it, it's a lot of noise, much ado about nothing for the last 6 or 7 months. And, you're correct in that. But there's clearly something going on with this weakness in the bond market, in my opinion, that continues to sort of permeate and sort of play underneath the surface. And there's the potential for that to boil over. So all of my concerns about yields going higher have not been at all assuaged.
Yeah, no doubt. Listen, just a little tease, maybe throw some questions into the.
I have one, by the way, from Gary Webb, if you want to real quick, and he's here every day. Most of these folks are. So Gary is saying, and I just looked at it, he's right. 7 of the 8, Dan's faithful 8, are down today. I think NVIDIA is the only one. Now, they're not down, in a huge amount, but the fact that, maybe some momentum is being taken out, I think his point is well taken. Momentum potentially is fading here, Dan.
Yeah, and there's another group I guess I'm more focused on, because I feel like tech is going to be the one that they can continue to come back to, and it's kind of one of the biggest drivers. I think if you're trying to figure out how we got to a new high and that sort of thing, and how we're hanging out here, I do see Apple went positive today. NVIDIA is positive a little bit, and Tesla is getting back a bunch of those losses from yesterday. So to me, I feel like they're going to keep coming back for it. If you look at the stocks, it's up 2.5%. This is one they continue to like. Intel is, some of those laggards, guy, are rallying a little bit. So you have Global Foundries up 7%. You have Intel up nearly 7%. So there's some interesting stuff there. I want to talk about a name within tech, though, Guy, and I don't know if you saw this deal, but CoreWeave, okay, this is a company that went public in late March. It's something that, to be very, very clear, I've been very, very negative on. I think the company is a fugazi, but what do I know here? A ton of debt. It's become a meme stock. What do? They rent compute. They basically buy NVIDIA chips. They have 250,000 of them. I think they have 10 data centers around the world. They have a massive customer concentration. With Microsoft making up 70% of the sales. And you know this, you've been talking about this. I mean, this IPO would not have gotten done if NVIDIA, which was already a shareholder, did not come in with a big order. The CEO said that, okay? Now, here's the deal, okay? CoreWeave exists because NVIDIA wants it to exist. NVIDIA wants another buyer of their chips other than the big hyperscalers, and that's one of the reasons why they supported the deal. It's one of the reasons why they've given a lot of business. So if you think about this, NVIDIA needed CoreWeave to keep a lot of that growth going, and the concern with CoreWeave and why you only see 4 buys, 15 holds, and 2 sells is that this business, these leases, like from big customers like Microsoft, could get pulled the moment things start to slow down. So now you have CoreWeave buying Core Scientific. These were 2 companies that were buying GPUs for, you ready for this? Bitcoin mining, which is maybe it's still a thing. I don't know if it's still a thing. This is more of a thing. So they're buying it 66% premium for when they started doing the deal. Let's pull up the Core Scientific chart. Okay, fine. The stock is still holding some of its gains, but investors don't like the deal. $9 billion using their currency. It's basically dilutive to existing shareholders. CoreWeave doesn't make money. CoreWeave is going to have a massive lockup for insiders coming pretty soon. So look at what's going on here. Core Scientific, you tell me if this is a good deal for them or not. Guy.
Well, I mean, maybe it's a good deal for Core Scientific. Well, I don't know who it's a good deal for. Let's put it that way. And I think to your point about NVIDIA needing a CoreWeave, you're 100% right. I mean, they are one of the, I don't want to say buyer of last resort, but clearly they're a huge customer of NVIDIA. And you're right to point out that if NVIDIA didn't step in at the IPO that particular day, it would maybe have been problematic. Maybe we'd still be here today, but obviously that day might have looked a lot different. I look at Core Scientific. I think it's trading about $14.50 today. Go back and look at where we topped out last fall. I think it was around Thanksgiving. Look at where we just topped out now. That obviously reeks of a double top. You can see it right there as clear as day. And in terms of the CoreWeave, this is where it sort of gets interesting. I think they're expected to do about $5 billion of revenues or such this year. That number is expected to jump to almost $11.5 billion next year. So I can do that math in terms of revenue growth. The question is, though, and to your point, is that going to come to fruition, or are we going to start to see a slowdown? I mean, I think to your point, you could see a market slowdown there, and that valuation that makes no sense today makes a lot less sense if that were to happen.
Yeah, I mean, this is one. The only reason I find this interesting because it is adjacent to this AI trade. When I say adjacent, fine, it got to about an $80 billion market cap. Let's go back to the CoreWeave for a second. And this is a stock that was stuck in the mud. Just go back. You could have bought all you wanted below the IPO price for a week or 2 or something like that, and then it became a meme stock. Institutions are not buying the stock. Retail's buying the stock. So at some point, you get all this overhang from the and listen, who knows, man, it could double from here. Okay, what do I know? But I think there's some funky stuff going on with this company, and I think that we're gonna see like a related party transaction. That I think is what's going on with all of this sort of stuff, and it seems kind of sketchy, but who knows? Have a ball. All right, this is the most important
I love when you say have a ball.
Have a ball, have at it. This is, I think, Guy, the most important thing going on in the market. Look at JP Morgan. Maybe they want to pull this thing up. When's the last time that you saw JP Morgan down 3% in a day? And you could say, okay, Dan, the stock was up 45% off its April lows. It's kind of blowing off a little, blew off top. Now it's coming in a little bit. Okay, fine. If it gets back and fills towards that prior high, the only thing I'll just say here is that down 3%, somebody is hitting the sell button. Okay. And is it the smart money? Who knows? But to have a stock like this down 3% and some of the other names, I think it's notable.
Well, yes, it is notable because you haven't seen a day like this in quite some time. I think it's also notable that, right before your very eyes, JP Morgan at its peak, and that was what I think last week or so. I think it traded 296 or something. I mean, it's trading close to 3 times book value. I mean, that's levels we haven't seen since the financial crisis. And that to me doesn't make a lot of sense in this environment either. So I think you're right to point out the price action today down some 3%. We'll see how it closes. I mean, there's obviously a lot of day left, but my sense is it trades about 8 million shares a day. I don't know what the volume is already. You can probably pull that up. But if you were to have a sort of a 2.5, 3 times normal volume day today with this type of price action, that to me is significant.
Yeah, it's already traded about 5 million shares,
Yeah.
Guy. And listen, it's just a big move, and I'm not saying that anyone should be panicking out of their bank stocks, but we were talking about it on Fast Money last night, and I seem to be the only one that seemed concerned about this. The book value, and you talk about this all the time, is nearly 2.4 times book. And I was looking at like Citi. It trades almost 3x Citi's price
Yeah.
to book. It trades nearly double Bank of America's price to book. And JP Morgan CEO Jamie Dimon, he said it again and again. He doesn't buy the stock back, you know what I mean, above 2 times book. So, I mean, listen, these are priced to perfection. These stocks right now, what are they discounting, right? We have earnings next week on the 15th, and it's one of the reasons why I started looking at the XLF guy. We know the XLF is not a perfectly constructed ETF. Berkshire makes a big chunk of that. Berkshire has actually been a laggard, has not made a new high. And so this is one where I look out to next week's expiration here, Guy. And I think the idea for playing for a move back towards 50, once you have all of these sort of money center banks and some of the investment banks come out here, they're just sharing my screen on the legend here. I want to go to the options chain, and I just want to kind of detail what I think look like dollar cheap options. What does that mean? Okay. We can look at the price of options in vol terms, implied volatility, and we can kind of, compare that to historical. We can compare it to a whole host of other things that might be interesting. When you see an ETF like this that has many of its large components reporting earnings, we know on an individual basis, you're going to see implied volatility. The price of options go higher into these sorts of events. Market makers want to be compensated for that potential higher risk. But when I say dollar cheap, I mean, okay, well, you have the XLF trading at right here, 52.33. And let's just say I want to go look at July expiration. That is next Friday's regular way expiration. And I can just kind of navigate here. I go to the at the money, and I'm looking at the 52, which is slightly out of the money. And I say to myself, 45 cents, Guy, that's less than 1%. If I'm buying the 52 put that expires next Friday, and I'm paying 45 cents for that, I need to move down to 51.55, okay, just to break even. And look at the way these stocks are moving. If there is slightly disappointing outlook or commentary, I think we get a move over the next, call it, 10, 9 trading days back towards $50. Now, if I were to kind of go here and look, I'm looking at the 52 put, I see it offered at 55. Let's just say I want to buy 25 of these sorts of things. I just think they're dollar cheap. Okay. So I'm going to pay right here, bang, 45 cents for 25 of these. I actually bought a little bit yesterday. I like the idea of kind of legging into this trade here. Breaks even down 1.5%. What do you think of my risk reward here? I think, again, the options, there's a really high probability, if I'm just looking from a delta basis, there's probably like a 41% probability that those are in the money on next Friday.
Okay, so let's break this down a little bit. If you look at the last, I don't know, let's call it since November of last year. I mean, this sort of 51.5, 52 level has been resistance a number of times. We obviously traded through it, but not significantly so. So we're right at levels that have been somewhat problematic in this for a while. Then you look at that trend line that I think either you or Jacob or Steven are throwing. So you look at that uptrend line, and that's from the April low. I mean, that third point, you can see where it is. Now, the question is, if and when we trade there, what's going to happen? I mean, obviously, the optimist is going to say we're going to bounce, but if you get some disappointing results on the back of what again has been overbought conditions, and go back and look at when this oscillator is traded. This is an RSI, I believe, but has traded these levels. That's typically when you see the reversal, and I think that's we're on the precipice of seeing again here in terms of the XLF that you mentioned is not the best created ETF of all time, without question. But I think we definitely got ourselves to overbought conditions. I think a test of that trend line is inevitable, but a potential break of that trend line is probably a bit of a coin flip here. So I will take that risk reward.
Yeah, and I guess what the way I'm thinking about it is I have a few trading days, obviously, until they report on the 15th. And, I might look to kind of roll this down. I might look to kind of use a 50% mental premium stop that I like to do. Let's just say the ETF goes sideways or starts to go a bit higher. I paid 45 cents for these. Again, my break even's at 51.55. Let's say they lose 20 cents over I'll probably look to cut it and kind of look and see, how things are lining up into the print. But there we go. Like, for instance, if it were to sell off and kind of break that uptrend prior to earnings, I'm probably not pressing it right there, especially after you have a JP Morgan down 3% today. So that's the trade I'm looking at. You see how I navigated on the legend. I like the ability to go back and forth. I like the ability to kind of put, a bunch of these different indicators in there. So there we are. All right, Guy, what else is kind of,
well, let's take a look. I want to take a look at Apple, because obviously it's gotten off the mat a little bit. There was some excitement, but if you start to parse through, and I know you do this, I mean, there's still a lot of negativity surrounding their story, and specifically sort of their AI intentions or their AI goals, or whatever term you want to use. I mean, it's clearly not as robust as everybody else's. And I would submit that obviously, although we've bounced since April, like everything else, Apple has not bounced to the extent that a lot of these other names have. And, we just tried to trade back to the 200-day moving average, seemingly failed there. We have a flattening 200-day, probably sloping lower, something we haven't seen in quite some time. I mean, I think Apple's sort of challenged here, Dan.
Yeah, and I look at this and you can say, all right, well, maybe it's just consolidating here, but it's consolidating at a level well below its 52-week highs, which is not something that is that consistent with a lot of that kind of Mag 7 sort of names, Tesla. And let's just put Tesla in its own little camp. So when you see a headline like this, that Meta is hiring Apple's chief of AI to go into their super intelligence group, there's a couple things I would think about here. Okay. One of them being that this person, maybe they just want the money, right? Maybe they think they like Mark Zuckerberg's vision for AI better than Tim Cook and Eddie Q and Federici or whatever, that's fine. Okay. Maybe they look at what they've been building there and they say, these guys are not investing in this the way they have. These guys have not instilled a lot of confidence in some of the smartest sort of developers or the smartest kind of folks in the space. And therefore, I'm going to cut my losses. That sort of thing. There's nothing good that you can take away from this. Now you can say, am I going to place so much emphasis on one person? Well, maybe not. But, the rumors that we had going on, just a few weeks ago, is that the company might have to buy a company like Perplexity for $13 billion, maybe more. Every day they don't do it, it gets more expensive. Let's just be really clear about that. The idea that they might license OpenAI's technology, well, that was the freaking announcement in June of 2024 at WWDC. That was the thing that caused the stock to rally from $193 that day to $205 or something like that. Remember that? Like, let's extend that chart a little bit here. So as far as I'm concerned, these guys are dead in the water as far as AI. I think that anything that they would do that would be transformational would be something that it would be so un-Apple. The largest acquisition this company had made ever was Beats for $3.2 billion. And that was a dead bang loser. So to me, I think they're behind, way behind. I think that's obvious. And if you're waiting for an AI super cycle upgrade of iPhones, you're going to have to wait at least until fall of 2026, in my opinion.
Now, listen, and I think you, and was it March of last year, and please correct me if I'm wrong, you came out and pretty vociferously said that Apple should buy Perplexity at a much different, when I say different, a much cheaper valuation. And now that seemingly is out there. That's sort of all the rage de rigueur, as the French say. So it's seemingly, I mean, the AI world is I don't want to say is past Apple by, because that's probably not fair, but it's lapping Apple in a pretty big way. And maybe that's not the driver for Apple. I mean, maybe I'm looking at the wrong thing. Maybe it just comes down to the install base and their services business and why they get a premium valuation on the back of that. But with that said, I mean, the stock is not performing with its peers at all since April.
Yeah. And again, pass it by or not. I mean, this is a company that was never particularly first to things, you know what I mean? But they end up doing it better. And I don't think they have the mind share there. They might not have the commitment from, the folks that are running this sort of thing. And I got to tell you, man, as well as Tim Cook has done expanding this business from the day he took over in 2011 and giving back maybe $1 trillion to shareholders over that period of time, maybe it would have made a lot more sense of thinking about what's next. They've had to kill, autonomous vehicles. They've had to kill a bunch of projects that people thought were going to be the next thing. This was the next thing. They kind of missed it. So it is what it is. Guy, let's look at the SOX for a second, the SOXX. And I can pull this up if they want me to drive here a little bit. This is interesting to me. Okay, because yes, we know that there's been a huge focus on the biggest names here, NVIDIA, Taiwan Semi. You and I like the SOX here because we think it's better, more evenly distributed. It's still well below, those all-time highs. It's a really beautiful 45-degree angle that you can see there. You can see the 50-day about to cross over the 200-day. That's what they call a golden cross here. Thoughts on the SOX here, because it definitely has underperformed IGV, the software ETF. Let me just pull that up for a second here. That's back at a level. I know what you said a couple of weeks ago. You think it's going to have a hard time here. Thoughts on, semis versus software?
Well, you saw the Samsung announcement, I think. I mean, there's clearly something going on, again, below the surface in terms of demand and the slowdown and those types of things. You mentioned that the golden cross in the SOX. Okay, that's fine. I mean, when we saw the death cross in the S&P 500, the day everybody started talking about that back in April was basically the balls low of the market. So I think Carter has pointed out the absurdity of these golden crosses and death crosses and how sometimes they're the ultimate counter indicator. And maybe, we're on the verge of that again. So I don't think you put too much stock in it. I know I don't put too much stock in it either, because as we've seen countless times, they've proven to be, if not an indicator, but a bit of a counter indicator. And again, right before our eyes, all these names that seemingly got themselves, in terms of valuation, reasonable levels a couple months ago, have gotten themselves right back to what I believe to be pretty expensive levels. And on top of that list, by the way, is NVIDIA.
Yeah. And so let's just go to software for a second. So the IGV, when you think about this name, Oracle makes up nearly 10% of the weight. Microsoft makes up 8.5%. So if you think about that, you have nearly 19%. Palantir, 8.5%. I don't like this ETF. I'm just going to be really clear on that, because if you have a stock like Palantir and the gains that it has really driving the performance, obviously Microsoft's made a new high. Oracle's been on a runaway breakout. But I want to go to some of the other names in this thing. So if you look at, hold on one second here, a Salesforce, some of these stocks in the application software space, they are getting left behind. Okay, like they are not participating in this AI. Let me just get rid of this there. Sorry. So when I look at this and I say to myself, wait, what's going on here with some of these names? I could show you Adobe. Okay. So all of these SaaS companies, they're under massive pressure from some of these AIs. Now, Adobe is obviously, a creation, a lot of creatives use this sort of thing. And, there's a company that tried to buy Figma a couple years ago. Figma is a design company that's coming right at Adobe and collaboration platform. And the EU would not let Adobe buy it. They were trying to pay $20 billion. Figma has just filed to go public here. So this is one that is under attack. If you look at some of this, like ServiceNow, okay, some of these SaaS names still hasn't come back. Workday. So I think that the IGV, to me, I want to sell that and maybe buy the. I think short IGV, long SOX is probably a decent trade right here.
I mean, Oracle's been the lifeblood of this whole thing. Or if you think, right? I mean, I think that's somewhat correct. Yeah. I mean, if you look at Salesforce, I want to say Salesforce made its all-time high, and you probably have this in front of you, in December, around 369. I mean, that stock has not performed well now for quite some time, and it's sort of been flatlining for the last month and a half. So there's clearly some trepidation around there. Oracle's one that I think we've collectively liked, but again, at $235, I think the stock made an all-time high today. This has been a parabolic move that clearly analysts have been behind and are starting to chase as well. And I think they're chasing at the wrong time. So I'm sort of with you on this one.
Well, it was the O in your hope trade. When you say
Yeah, it was. Man,
this
that
has been
damn
one.
straight it was.
Yeah, but you know what's interesting, guy? I have not been in this camp whatsoever because I believe that this company is just a massive roll up, right? The organic growth that they've seen, they're late to the game as far as their OCI group. This is the cloud group. They got that huge deal from OpenAI. You know, they've been spending about $25 billion a year for the last 2 years on CapEx, and they've been kind of trying to build out this infrastructure. So they get this deal. It's probably Stargate related. You remember that was Masa Son from SoftBank, OpenAI, Sam Altman, and Larry Ellison. But to see a company like this move the way it has, and it's on the come, they're going to have to spend a lot more on CapEx to be able to satisfy that cloud deal. You know, the fact that they've gained, you know, hundreds of $billions in market cap in just the last couple of months, that's pricing a lot of future growth in. So that's my 2 cents. I think you could throw a dart at some of these ones that have gone up like this, and you'll probably make money in the next 6 months. I want to hit one name that Carter keeps bringing up, guy. This is the Roblox. Look at this thing, man. I mean, look at the steepness of that move. Look at how it's just ground higher, grounded higher. What do you think of when you see a stock like that move that way?
Again, I mean, it's not unlike some of the other names that we've seen. You talk about a lot of these companies becoming meme stocks, and I think that's exactly right. I mean, there's clearly a chase for performance as we've gotten ourselves into July. There are different factions that need to sort of play catch up, and they try to do it in names like this where they're going to get some bang for their buck, but it clearly is divorced. This is my opinion. It's divorced itself from fundamentals. Not that that matters clearly in this environment, but at some point it does. So when I see that, it flashes red to me. But with being honest with you, it would have flashed red to me 15 or 20% ago, probably.
All right, guy. But here's the deal: this company in its existence has never turned a profit. They are not expected to be profitable on a GAAP basis until 2029. And then the other thing I'll just mention here is like the revenue growth. This is not like a crazy growth company. They're expected to grow sales this year, fine, 45%, but for the next 5 years at about 20% or high teens. And I just say to myself, again, there's no discounting anything right now in most of these sorts of businesses. So I just wanted to highlight that.
Listen, what is Roblox? A $70 billion company. And I think next year they're going to do about $6.5 billion of revenues. Again, I mean, it's just historically, that's not a multiple that makes a lot of sense. Now, people will say, well, look at the growth trajectory of the revenue and they're going to grow into it. Maybe. But to your point, I mean, they're going to lose $1.50, I think, this year. I think they're going to lose $1.20 next year. I mean, you just said it. It's 2029 when they're profitable, maybe. So, look, again, none of that seems to matter. Real quick before we sort of skate, Carter Evans is asking about the downgrades of the banks by HSBC. We actually have a slide to talk about that. So, as they say, slide it, Earl. And I think what Dan talked about earlier and what I sort of said to back him up makes us believe that we sort of like these downgrades. More of JP Morgan and Bank of America. Goldman Sachs has probably gotten ahead of itself as well. We have mentioned Citi being cheap comparative to some of these other names, and that's played out. But, I think the JP Morgan downgrade is prescient on their behalf.
Well, and I also find next week, I think Bank of America also reports on the 15th. Let me just kind of go there because it's like that dueling split screen of, Jamie Dimon and his kind of.
BAC is on the 16th, I believe, before the bell.
Yeah, so it'd just be interesting, I mean, Moynihan has been, fairly optimistic about a consumer, and you brought up some of those kind of default rates that are sort of ticking up in a way. So this stock has gone from 33.5. It went as high as 49.25 just the other day. So big move. Again, I just don't know what they're doing. Listen, I'm not railing against the market here. What I'm railing against is just some of these moves and what they are pulling forward as far as performance, you know what I mean, going forward. So that's my 2 cents. Guy, I just want to hit one other name before we go. Look at Walmart for a second here. And so let me just pull this one up. This is an interesting one to me. We've been talking about this trade down for a couple of years, right? By a higher end consumer to this. I think it's interesting going back to their earnings. It was a huge gap. Remember, it closed down 6% on that last print. And then obviously into the April 2nd lows and this or whatever. It's come back, but not nearly as much as the S&P, not nearly as much as some of the other beaten down retailers. And it doesn't trade cheap, right? And I just want to go back to a 5-year because I want to get your take. Look at this blip. This is going all the way back to 2022. Remember, they were having problems post-COVID dealing with different inventory things.
Them and Target, and then Walmart figured it out and Target didn't. Absolutely.
All right. So my question to you is that, don't you think there's potential for inventory issues in this new trade sort of situation here? If anybody's going to be able to deal with it, fine. Walmart is going to be able to deal with tariffs and how they kind of pass some of those through onto their suppliers or this or whatever. But again, maybe this is one of the reasons why the rebound has not been dramatic and the fact that the stock is kind of stuck in the mud here.
No, I think history could repeat itself without question. I think some people, the optimists, will say that they learned from those mistakes 3.5, 4 years ago and are better suited now. The AI component of Walmart in terms of what it's done for their margins is impressive. You're right to point out that the rally since that April low has not nearly been as robust as the broader market. But with that said, when you made it all-time high, that stock earlier in the spring, we both talked about how obscene the valuation was and how into earnings it made sense to sort of take profits, and that proved to be correct. I'm sort of shocked here that it's still at levels that valuation-wise are still a little bit excessive. So on the one hand, you could say that the rally has not nearly been as robust as the broader market. On the flip side of the coin, you could say, despite valuation headwinds, it's hanging in there pretty well. So I'll be honest with you, I don't really know what to make of Walmart right now. I think there's a resilience to the stock that people are underappreciating.
Yeah, 38 times trailing, 33 times forward. Again, that will only matter if the performance of the business starts to kind of deteriorate a little bit. But to your point, this is one company that has not had problems with deteriorating fundamentals since they got that inventory situation sorted out. You and I, let's dig deep into some of these oil names next or tomorrow, because I know that's something we wanted to hit. And some of the news out of OPEC Plus and some of the news about global growth and a whole host of things, valuation. We keep hearing a lot of these strategists who kind of got back on their horses with their targets, above 6,500 guy, talk about some of these value areas. So maybe energy will be one that we hit tomorrow.
We will. We have some questions about it. We'll hit it tomorrow. We also have a quick Lululemon question from Jack. I will tell you, Jack CF, that we have been negative on Lululemon for quite some time. We've talked about specialty retail. Jeff Mack used to say it's where hope goes to die. And it's not different with Lululemon. We're on the other side of the growth curve for them, and that's problematic. There are a few analysts out there that are still negative on the name. There's been no real meaningful bounce in the name since that last quarter. I don't see any compelling reason to own it other than you're playing for some oversold bounce. That's just my opinion, Dan.
This is also, just pull up my screen really quickly on the legend here. This is one of the worst looking charts guy I've ever seen in my life. If you just think about, how this thing has performed after a bunch of those earnings announcements, the beats, the misses, the guide downs, that sort of thing. So this is sitting on a level that is not particularly healthy for this chart. And that's it.
Danny Moses will be on CNBC's Fast Money this evening, I believe, with me, you, and Karen Feinerman. So that'll be fun. And again, back in the saddle, I am definitely focused on a few things. The bond market clearly, but this little this technical setup we're seeing the potential for in the month of July, I think is something that everybody should continue to watch. So I will be laser focused on that, Dan.
All right. Thanks, everybody. Appreciate it. It's great to have Guy Adami back with us on the market call. We have a great conversation with Peter Bookvar that's in the Risk Reversal media feed right now in your favorite podcast store. Also, Brian Belsky from BMO Capital drops tomorrow. You and I, for the Friday drop, we have Stephanie Link of Hightower. Those are always very, very well received. She comes bringing it with a whole host of different ideas. So we got a lot of stuff going on. We'll see you back here tomorrow on the market call.